Hey everyone, it's Julie here with TipRanks. Today we're taking a look at some of the newest buy ratings from a top-ranked finance analyst. So let's get into it. All right guys, welcome back. Thank you all so much for being here. Today we're taking a look at a top analyst in the finance sector and 3 stocks that he very recently rated a buy. We're going to take a look at these companies, what it is that they do, and of course how the rest of Wall Street weighs in. That top analyst is Mark Hughes from Truist Financial. On the top Wall Street analyst page, you can find Mark in the number 2 position out of 9,200 Wall Street analysts. He has a 78% success rate over the past year, and here's a list of his recent coverage. Just before we get into Mark's latest buy ratings, this is a reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can see Mark's stock coverage over on the TipRanks website or right on the TipRanks mobile app as well. Links to download will be in the description down below. Now let's jump right into these top analyst finance stocks. First up is a company called Frontdoor. They provide home service plans and are dedicated to taking the hassle out of owning a home. They combine financial protection via warranties with convenient tech-enabled repair and maintenance services. They are the parent company of several brands, with their flagship being American Home Shield, which is the largest provider of home warranties in the United States. On top of that, they also provide a one-stop app that connects homeowners with professionals for repair and maintenance needs. They have a nationwide network of over 15,000 professional contractor firms employing more than 45,000 technicians. This allows Frontdoor to respond to millions of service requests annually. Now, their stock is in the green for this past year, but recently we have seen a sell-off. Trading under the ticker FTDR, they're currently priced at $42 per share, having gained over 35% in the past year. But if you notice, recently we took quite a dive. In the last 3 months, they're down about 30%. That recent stock sell-off was linked to their most recent quarterly report. The company did come out with an earnings beat. In fact, they more than doubled expectations and had a lot of other positives. However, their future outlook was weaker than expected. Quarterly revenue of $383 million beat by over $15 million, and their full-year revenue of $1.84 billion grew 4% year-over-year. The company also utilized $160 million to repurchase about 4 million shares during the year. And their earnings per share came in with a big beat at 27 cents, beating expectations by 16 cents. On top of that, the company saw record gross margin improvement and launched their AHS video chat with an expert. They're forecasting full-year 2025 revenue to be between $2 and $2.04 billion. This did come ahead of the consensus $1.94 billion, but it seems that investors were underwhelmed. After a year of really strong performance, they were expecting some more aggressive targets. Their chairman and CEO said that 2024 was truly an exceptional year for Frontdoor as we delivered record financial results, our operations performed better than ever, and we completed the acquisition of 2-10. This year, we're taking decisive actions to drive long-term growth in home warranty membership, expanding non-warranty services, and optimizing the 2-10 integration. Of course, it's no surprise that our 5-star Truist analyst, Mark Hughes, did rate the Frontdoor stock a buy. And that came with a $67 price target, implying an upside of over 50% from current prices. Mark has rated the stock 16 times before and does have a 75% success rate. Overall, Frontdoor does just have 4 current analyst ratings, but does come in as a strong buy with 3 buys and 1 hold. And the average price target is $62.50, implying an upside potential of 48%. But only 2 out of 4 analysts have actually given a price target. Our hold and another buy rating did not. So on the low end, we have $58 for an upside of 37%, and the high end is $67 for Mark for an upside of that 58%. So we'll keep an eye on that one and see how far it continues to drop and where an attractive entry point might be. Second on our list, we're taking a look at the HCI Group. They are a holding company primarily focused on property and casualty insurance. They operate through several subsidiaries to provide a range of services. They manage insurance carriers such as Homeowners Choice Property and Casualty Insurance Company, which focus on homeowners insurance and commercial residential insurance. They also have their wholly owned reinsurer, Claddagh Casualty Insurance Company, which manages reinsurance cycles opportunistically. Their insurance offerings target homeowners, tenants, and condo owners, supported by a network of agents and an online platform. Unlike Frontdoor, the HCI Group has been gaining lately. Trading under the ticker HCI, they're currently priced at $139 per share. In the past year, they've climbed over 42%, and you can see recently they've taken another jump up. They've gained over 18% in the last 3 months. And once again, that recent stock movement, this time positive, was linked to their earnings report. On February 27th, the company came out with a surprise earnings beat. Many were expecting a loss per share due to impacts from recent hurricanes in Florida like Milton, but the company did come out with a profit. For their fourth quarter, analysts were anticipating a loss per share of $2.98, but HCI Group came out with an earnings per share of 31 cents per share. Revenue came in at $161 million, which did miss by $13 million. Management said that even with the hurricanes in 2024, they are unwavering in their commitment to Florida and supporting their existing and new policy holders. And as a part of their ongoing efforts, they plan to keep rates flat for the foreseeable future. Now, Hurricane Milton did have a net impact of $128 million, but also during the quarter, they retained approximately 90% of their policyholders and saw some strong growth as well. They also paid a dividend, which was their 57th consecutive quarterly dividend. And looking at that dividend, it is currently $1.60 per share for a dividend yield of 1.2%. Following that fourth quarter earnings report, our top analyst, Mark Hughes, increased his price target by $10. His buy rating now comes with a price target of $155, implying an upside potential of over 13.5%. He has rated the HCI Group 23 times before and has an 80% success rating on the stock. HCI Group does just have 4 current analyst ratings, but does come in as a unanimous strong buy. The average price target comes in at $161. That implies an upside potential of over 15%. And looking at those ratings down below, on the low end is actually Mark at $155, and after some gains today of 6%, that now represents an upside just under 11%, while our high end is 2 price targets at $165 for an upside of over 18%. If you've made it all the way to our third stock today, then this is a reminder to make sure you've hit that thumbs up button. Third on our list, we have a BDC with Nuveen Churchill Direct Lending. They are a specialty finance company. They provide customized financing solutions, mainly senior secured loans, to private equity-backed U.S. middle market companies, aiming to deliver consistent income and long-term value to investors through a robust tech-supported platform backed by industry giants Nuveen and TIAA. They specialize in directly originated loans, meaning they work directly with borrowers rather than buying syndicated loans from broader markets. Nuveen Churchill Direct Lending is in the green overall this past year. They did take a dip heading into the new year, but have been climbing back since. Trading under the ticker NCDL, they're currently priced at $17.45. In the past year, they've gained about 20%. You can see going into January here, they did go on a decline, but have been climbing back since. Overall, in the last 3 months, they are up 5.25%. As a BDC or business development company, they are subject to specific dividend rules where they must pay out a certain percentage of their net income as a dividend. This leads to some very attractive high dividend yields, but it is worth noting that they are taxed as ordinary income, so it's worth considering this before you invest and what type of investment vehicle you hold this stock in. Their current quarterly dividend comes in at about 45 cents per share for a dividend yield of over 10%. Their next ex-dividend date is March 31st for payment on April 28th. Another thing to note about this company is that they just fairly recently IPO'd. They hit the public markets in January of 2024, so their most recent quarterly report, which just came out on February 28th, was only their 5th as a publicly traded company, and they did fall short of expectations. For their fourth quarter, they reported earnings per share of 54 cents, which did fall 4 cents short of analyst expectations, and they had a net realized and unrealized loss in investment of 2 cents per share. Management did say that they were pleased to end 2024 with a strong quarter of financial results, reflecting the positive momentum that they've built throughout the year. They did see their net asset value increase to $18.15, and they saw $226 million of new originations, primarily focused on senior secured first lien loans. Our top analyst, Mark, reiterated a buy rating just today, and as a fairly new publicly traded company, this is just his 6th rating on the stock. But he does have a success rate of 100% on the NCDL stock. His buy rating comes with a price target of 19% for an upside of 8.5%. And looking at the last 3 months, Mark's rating today is the only current analyst rating. So his price target of $19 is the only one showing up top here. Now, other analysts have rated the stock before over this past year, but none have reiterated their buy ratings since that earnings report. So over the next few days, we may see some of them weigh in. So that is a quick look at 3 stocks that have all picked up buy ratings from a top finance analyst in the last few days. Let me know your thoughts on these companies and which one sticks out the most to you. I know they're all quite different from each other, so I'd love to hear your thoughts in the comments down below. Keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always stick to your own research and due diligence. Thank you guys so much for watching. I hope you have a great day. I'll see you back here next time.